Everyone, my name is Yorick de Mombynes. I work at the French Court of Auditors, Cour des Comptes, and I'm very happy to be moderating this panel on stablecoins. We are with Pietro Grassano, Alex Hernandez, and Gael Itier, and we were supposed to be joined by Zarodin, but he could not come today, he's sorry, and so we have three excellent panelists. And first, I would like to ask each of them to introduce themselves. Who are you? What do you do? Pietro.
Pietro Grassano. Sorry, there was an interesting set of parties yesterday night, so my voice is a little bit low, but hopefully you'll hear me anyway. I take care of business solutions, which is essentially business development for Algorand's blockchain protocol, which is a layer 1 blockchain protocol funded by Professor Silvio Micheli that you probably heard yesterday in his keynote speech in the main stage. I come from a career in asset management and traditional finance, and voilà, that's it.
I'm Alex Hernandez. I come from mechanical engineering, and we are onboarding a company in Switzerland. It's a layer 1 blockchain in Polkadot, so a parachain, aiming to merge the whole retail and corporations. And there's a DEX, lending and borrowing, NFTs, etc. We have even a decentralized custodial manner inside Polkadot.
Hello, I'm Gael Itier from Hack.io. So the voice is not so good with me as well. However, my night yesterday was not so same as you, so I was not in the party. So I'm the CEO and the founder of Hack.io. I'm very proud to be here today. So it's a company since 4 years now. We launched our coin yesterday night, so we are proud of that as well. It's just incredible, something to live. So this company is trying to become an innovation in a neobank in a way that we would like to become the first world bank. I love to say that. So currently we are observing that banking industry and even neobanks are just focusing on spendings. The cards are really heavy, they are fancy, so you have Google Pay, Apple Pay, notification when you pay, everything is around spendings. And the situation is now, especially with innovation in blockchain, cryptocurrencies, but not only, that it's the time to go into savings and wealth management to help people to have full access of these new technologies, such as blockchain, that we can bring to the table very easily. In this industry, which allow the retail market for once to have something good in their hand.
Thank you very much. So we have 35 minutes. We'll try to keep some time at the end for some questions by the audience. I propose we talk about 4 main aspects. First, let's have a quick overview on the stablecoin ecosystem. Second, let's talk about the advantages of stablecoins. Third, let's see what kind of drawbacks or risks there are with stablecoins. And finally, we should try to analyze some prospects on the future of stablecoins, especially in the DeFi ecosystem. So, who wants to start with a quick overview on the stablecoin ecosystem? What is a stablecoin? How does it work? What are the main stablecoins that exist nowadays? And everyone can add some comments. Alex?
Yeah, so stable coins are pegged to the dollar, for example. This is the most common ones, which they normally try to stabilize the whole market on the ecosystem. And there's like 4 main ones, or type of them, which is the crypto-backed ones, which would be more like DAI, which they have below like assets or home equity, etc. There's the fiat-backed ones, which is USDT, USDC, so fiat collateralizing this stablecoin. Then there's the one from algorithmic ones, which they mint and burn, so there's dynamic supply going on there. And then, which would be a little bit more On the limit would be like commodity stablecoins, which is Pax Gold, USDT Gold, which are collateralized by precious metals and things like this. And they are very helpful because institutions, big partners, corporations can have their stability inside the whole crypto ecosystem by an understanding this crypto, and it's even easier financial products that can be made through these cryptos.
Thank you. Any comments in addition on that? What's the market cap of the stablecoins? Where do they come from? What kind of firms issue them?
So,
what are the main ones?
If I may try to go one step back and try to give a even broader definition, right, of, well, stablecoin is stable to something, right? It's a digital representation of value, which happens to be on a blockchain, which is the perfect infrastructure for digital representation of value with no double spending by design. That's what the blockchain brings to the party. That's the innovation the blockchain does. And it's stable to something, right? That something can be, as you said, a commodity, fiat money, other cryptos, algorithmic logics, and so on. And therefore, the mechanism is the one of collateralization of this representation to that something to which we want to be stable to. And therefore, actually, that's where the devil is. It's in the detail of collateralization. Is the stablecoin you are looking at well collateralized? Are the pegs done to fiat, commodities, other things, well established or not? This, to me, is the central element, how you stabilize towards that specific basket of currencies, single currency, bank deposits, and so on. The market is pretty broad, and there are many things that you label stablecoin. Then you need to look under the label and understand what there is actually into the stablecoin. Some of those stablecoins are 100% collateralized by bank deposits in fiat, for instance, or are 100% collateralized in commodities that the auditors tells you that actually are there, are present, and therefore can meet the, let me say, obligations that a stablecoin issuance bring. The most common are probably USDC, USDT in dollars. They have different mechanics of collateralization. Circle, the issuer of USDC, is, I think, applying for a banking license, right? And the regulators are seeing stablecoins in fiat as another form of commercial bank money. Not all money in fiat is central bank money. Cash is central bank money, is a liability of the central bank. Other types of money, the one we use with our ATM card when we pay the coffee at the bar, is commercial bank money. It's a liability of the commercial bank that then needs to have her reserves at the central bank. And this can be a way to create commercial bank money, essentially. And the regulators are looking at this in the same way. Then the auditing and the logics of collateralization, let me reiterate, are literally the most important part of the conversation around stablecoins. It's billions, right? I don't know exactly USDC. I think it's USDT is around 40 billions, and USDC must be more or less the half of it. So
I think the sum is more or less 200 billions.
Yeah, altogether.
Gael, you wanted to add something?
Yeah, absolutely. So, especially based on what you said, guys, and maybe something to add very basic, say why having something stable in this world of cryptocurrency, which is the opposite of stable, very, very volatile. So I think it's really interesting to also to discuss the history of the growth of stablecoins. So interest of stablecoins is really important to explain, especially based on the amount you said, so in billions. So it's something significant today. So it's absolutely necessary to explain that there is a need of having something stable, especially it could be to exchange cryptocurrencies against something to prevent from volatility on the market. If we don't want to stay in Bitcoin, in Ethereum, or the latest tokens, for instance. So if you want to be out of your investment, so it could be a good opportunity. It could be a good opportunity for payments as well, because payments is obviously something that you don't want any volatility during the payment, obviously. And currently, and we can jump into these discussions in some seconds, also the rise of decentralized finance, which helps these stable coins to grow a lot, obviously. But back to the history, so of cryptocurrencies in general. So before 2017, so where it was only early adopters, it was just for speculations. It was to be used for, I say, to retail market, on gaming, on dark web. We know that, all of us. And thanks to the rise of 2017, we had a chance to go deeper into this kind of market with retail market, saying that, okay, there is an opportunity to make money with cryptocurrencies. So it was not really the discussions of stable coins at this moment. It was existing, but it was not something really significant in the market. It was more Bitcoin, step-by-step Ethereum. And after this big raise between 2017 and today, new technologies are arriving, such as DeFi, and now this market is increasing a lot.
Yes. Do you guys see any other advantages of stablecoins for the market, for cryptocurrencies market, or for liquidity, or any other things? Maybe Alex?
Yeah, I see one, which is, for example, Terra, USDT, is doing, which is has acquired more than 231 millions and over 100 in AVAX, which they are trying to bring their communities inside Terra. So they are playing through this collateralization of these crypto-backed stablecoins, playing the role of bringing other communities into Terra, for example, the Avalanche one through AVAX, and this can boost their whole ecosystem. So they are playing with their stablecoins, playing the game of bringing communities into it.
Okay. Before we talk about the drawbacks, do you have examples in your own activity, your own business, in a way you use stablecoins to facilitate the business?
I mean, it depends on the type of stablecoin. As we said, there can be stablecoins that simply represent digitally on a blockchain fiat money, right? And with that, you can have a wholesale type of utilization of a mean of payment. So, I mean, you can buy in our ecosystem PlanetWatch sensors. PlanetWatch is a company that does sensors for the air quality. They stream the data to our blockchain and they remunerate those that are giving the data with their own token, right? And you can buy in stable coins. You can buy their own sensors, right? So it's a bridge between even real economy and the financial system. There can be many other utilization. One advantage that I see, which at the end of the day is an advantage of the blockchain infrastructure for I mean, representation of payment methods and so on, is that it allows, for instance, programmable money, or it allows micropayments related to IoT devices. There will be a world, we expect in the near future, in which there will be automated payments between various type of IoT devices, exchanging information, and of course, allowing people to monetize out of this data, right? So there is a sort of rebalancing between the platforms that tend to alienate the data and the user that with its own sensors is giving data to the platform. So that's essentially some of other uses that you can see.
And Gael, you were talking about the coin you launched yesterday. How will you use stablecoin in your activity?
And yeah, so first of all, from what you are saying, and very basically, I think I would say it's the perfect entrance for anyone, for the retail market, to go into blockchain. I think so. As you said, it's the gap, it's the bridge between the fiat money and the cryptocurrencies. But very basically, all of you guys have your salary in euro or on GBP, on CHF, on USD. And this is the money you are managing every day. So it could be for payments, to live, for everything. So obviously, stablecoins could be a good actor for payments. But as I said before, it's not only payments in life. You also need to increase money to use this kind of technologies such as DeFi to improve your life. And the way we are using stable coins is very basic. So we are considered as a platform where you can put money on it and use it as a neobank every day. So obviously you are putting, if you are European, you are putting euro on that, nothing else. So if you want to enter in blockchain technology, in these latest technologies, you need to transform it in something that can be used in this kind of ecosystem. And the best way is obviously to transform your euro or GBP into a stable coin. And the way we are using that on our side is very basic. So it's the alternative of savings account. In France, you know, the livret A. We are doing the livret blockchain. That's it. That's all very basic. You put euro. It's transforming a stable coin in euro. We are using the PAR, which is on MIMO protocol, and very basically you can activate interest rate by using the DeFi. And it's on our side the best way to help anyone. I mean anyone, retail market people, to change their life by using these new technologies. And it's something significant that you can understand that anyone can now go to this kind of technology by the stable coins, for instance.
Okay. Should we jump on the drawbacks and risks of stablecoins? What are the main drawbacks? What are the main risks of stablecoins, and how should we address them? Should we trust market processes, competition, private auditing, private labels, or should we trust the regulation to address those risks? And what are the drawbacks of the regulation preventing the development of this new ecosystem? Who wants to start on that?
I'll take it. So, to me, the main drawback of a stable coin is that it's not stable to what it promises to be stable to, right? So it's bad collateralization. This is, to me, the potential main drawback, because that's where the implicit contract, the implicit promise with the user breaks, okay? And on that, I think that, as you mentioned, there can be market forces and regulatory rules that combined can play a role in making the market for stablecoin a more reliable market. I think that, I mean, the answer public-private when it comes to how to organize a market is essentially both. I mean, you cannot avoid the situations of market failures without a public type of intervention. At the same time, the public intervention is no guarantee that there will be no hidden situations that can be actually arbitraged away by market forces. So there need to be a sort of collaboration between the two sides. So a better quality stable coin can, of course, play a role, not showing its better collateralization versus a lower quality stable coin, and therefore gain a sort of competitive advantage, and therefore make the marketplace a better place. Regulation has a role when it comes to market failures, as I said before, where the individual incentives are not good enough to create a benign ecosystem. The risks is that regulators do not fully understand the technology that is behind. For instance, they do not understand that blockchain per se is not anonymous, is pseudonymous, right? So there are ways to address the traceability of KYC, AML, CTF type of logics within a blockchain, and they tend to utilize the same dimensions of regulation that they use for centralized systems, right? An important thing that the regulators need to understand is that this is an infrastructure. It's a novel infrastructure that has the beauty of representing value in the digital age with no double spending by design, without the need of a set of centralized databases in series with intermediaries in between each of the centralized databases. That's the beauty, right? The network effect of blockchain. And therefore, regulation needs to take into consideration the technological logics that can, via cryptographic primitives, strike the right balance in the trade-off, for instance, between privacy and traceability. Right? There are today the right cryptographic primitives. There has been an evolution in this that can accommodate these things. So that's the risk of the market in se and the risk of the excessive regulation that doesn't understand fully what we are talking about.
For example, there's the ones which can be audited, which is from the traditional side, and there are also the algorithmic ones which can be pegged by minting and burning. So that's a new way, dynamic supply. So that's a new way of auditing, which can be also very helpful for the regulators without having private companies to really have a look in it. And even for the future, or it's already happening through Curve, which is a stablecoin protocol, with a tree pool, which people and big corporations can even be exposed to stablecoins, not with one, with three, for example, at the same time, and even they want to move into the 4-pool one and enter USDT and Frax, which USDT is collateralizing his own token, which Frax. And in this sense, it's bringing like a new sort of potential or philosophy inside stablecoins, which is stablecoins being stabilized by other stablecoins, which are already in the market. In this case, a crypto stablecoin being collateralized by an algorithmic one, which makes it, as I said before, bring different communities into different protocols, moving them around, and even making the whole ecosystem of stablecoins like even more stable, because you have your stablecoins distributed into more stablecoins. So it's like a different and deeper knowledge of what is even fiat or the stability of our current knowledge.
Yeah, thank you. There are many discussions potentially here. Something that I love to say is when it's very basic. So currently, I think you guys are thinking, when you are talking about stablecoins, we are talking about especially of USDT and USDC. We know that, all of us. So, and if we are talking about risk, we can go in deeper in discussions by explaining the things, by potentially going into something different in terms of technology. But when it comes to just the basics, such as USDT, for instance, the most important to know is the risk is if I don't know if it's when, I hope so, no, but if regulators such as the SEC, for instance, detect something wrong in collateral in USDT, and how? Simply by checking, by auditing the company and seeing that potentially something is wrong, such as having investment into the collateral. And all of you guys knows already what happened in 2008 with the subprimes, and it's something similar to that. So this kind of problem can can happen again, especially with stablecoins, because they can potentially have inside the collateral something else than just USD as a collateral, such as investment. And in that kind of case, the problem is there is a big risk of fail. And if it fails, how central banks can solve that kind of problem if the market is too big? It's currently being very huge, and they are afraid of that. That's the reason why current regulators are trying to give license, audit all these kind of companies to ensure that people who are going to this kind of market, I mean stablecoins, USDT or USDT and so on, that are in good hand to use that. Because if we demonstrate that it's not well collateralized, the problem is the market can go at zero potentially. So all the money of people is no more stable. It's just failing instantly. That's a problem.
Yeah, exactly. And you described the risk for a specific stablecoin, but what is the systemic risk? Imagine that today one of the major stablecoins goes bankrupt, or there's a default, and we see what you describe. What's the systemic risk for all the cryptocurrency ecosystem? What happens to the market of Bitcoin and others? And what's the probability of this event today?
Well, frankly, I have never seen a central bank having to step into the crypto world to save a sort of too big to fail situation so far, while I've seen it in the traditional finance world. Having said that, of course, yes, there can be, when we are talking about systemic risks, we are talking about risks that spiral down from, let me say, the balance sheet of one entity to the balance sheet of another entity, because asset and liabilities do not match, right? That's what we're talking about when we're talking about systemic risk. I don't think that the crypto world today is big enough to represent a source of systemic risk per se. I don't think that the institutional money world is particularly exposed as of today to the crypto world.
Yeah, we can talk about the risk within the crypto world.
Exactly.
A systemic risk within the crypto world.
Then it's not that systemic, right? Because systemic should be holistic, so it should be system in Greek, keeping inside everything. So the risk, the internal risk, yes, of course, it's related to the fact that if the collateralization is not done in an appropriate manner, of course, you will not match your liabilities with the assets that you have in your portfolio, right? And this can affect assets that are related to the main cryptocurrencies, bitcoins, and so on and so forth. But the floor, the limit that I see to this systemic risk is that when you are buying a cryptocurrency, essentially, in my mind at least, you are buying a warrant, an option on the underlying technology, okay? If you are aware of this, and if you are not taking this as a sort of investment logic, investment advice, and so on, you will be somehow tempted to hold because you think that the technology behind, with its own adoption, use cases, and so on, will eventually be able to wash away the false capital, right? The situations in which assets and liabilities do not match, and you keep the value of that warrant on the technology. So I see a sort of fundamental logic that, for instance, wasn't there at a certain point during the subprime crisis, right? There was a sort of panic and systemic risk because you didn't know what your counterparty had in its own balance sheet, and if it was able to open up the windows and the door of the bank the next day. So you were tempted not to lend anymore. The second backstop that I see is that this technology allows much better systemic traceability than the serial centralized databases system. So you can somehow have a better understanding of your counterparty risk compared to the traditional finance logic. I think that this is also one of the reasons for the regulators are looking technologically at this technology in a pretty interesting way. There was a speech of Janet Yellen, right? Not exactly a crypto enthusiast in the past, but a couple of days ago she gave a speech in which she said, well, this technology is changing the way finance is working, right? And she was mentioning decentralized finance too. Because, of course, decentralized finance, via the network effect, changes a little bit the landscape of systemic risks and brings it down.
I propose we jump on the fourth part, the fourth topic, after the overview, the advantages and the drawbacks of stablecoins. Let's talk about prospects. And we talked about existing stablecoins, but what about the very famous non-existing stablecoin, which is the Facebook project? Libra, then Diem. As far as I understand, it was a project of stablecoin. What kind of stablecoin is it, or was it? Where are they? And what lessons can we learn from this specific experience?
It was a fiat-backed currency, stablecoin, which was backed by euro, money from England, dollar, pound, etc. And in my opinion, was a failure because they were going through too much regulation, maybe, and it was too early stage. And in this sense, they had some big failures. In this sense, they brought very big companies like Visa, MasterCard, all these big guys, but the American regulator got very scared because they could be a really amazing competence to the real dollar, let's say. And even going back before from what I said from Curve and letting it like in parallel with Libra, is that nowadays also stable coins can be a risk in some way because or like it's a different manner of thinking because there's, for example, that the triple that I said before about Curve is being substituted by DAI is just being substituted by USDT and the next one. So DAI is getting out of a pool which is an amazing and huge pool with many billion dollars inside, and now it's being substituted by two other stablecoins. So this risk about substituting one stablecoin for another one can bring the first one on some sort of crisis and even make it, as you were saying, like a systemic risk, because it could make like, not MakerDAO at least, but the whole DAI ecosystem like a little bit unstable, because that was like a huge pool of it.
Another question, why are all the stablecoins in the US and not in Europe? What may explain this delay? What is happening and what are the prospects on that, Gael or any other? How do you explain the current situation and how do you see the future?
Directly working with a company which is which has created the PAR Euro stablecoin, which is MIMO. The thing we are saying together is it's US market which is driving the things. So it started like this. It's the first one. USDT started, and then USDC. So the current market is in USD for the moment, with that, and it's growing. The market in euro, for instance, is growing, but America is big. USD is really big. Euro is certainly start to be important. It could be something that is coming to the table. I think so, and I hope so as well, because, as I said, it's the perfect bridge between retail market and this kind of new innovative technologies, such as DeFi. And it's something which needs to grow in euro or other currencies. But when it comes to GBP or CHF, for instance, how you can help this kind of market to grow when it's for specific countries, it's difficult to say. So at the end, I think the opposite. At the end, it's it's USD which is the market, obviously.
Okay. Maybe one last topic before we jump on the questions. Should we talk about the CBDCs, central bank digital currencies? What link is there with the stable coins?
Yeah, I mean, central bank digital currency, the name tells us, is a liability of the central bank. And a stable coin, again, is a collateralized form of mean of payment or other things. Again, we said there are stable coins that are stable to a basket or a commodity, right? And they are, anyway, a private sector type of thing. My personal view is that as today, one can imagine to articulate a combination of the two things, for instance, central bank digital currency in the form of wholesale interbank settlement type of tool, and then without wound to the fractional reserve system, that is the one that allows some growth, right? The fractional reserve is not the devil, it's a system that works pretty well in creating credit for the whole economy. You can use a private issued stablecoin issued by a licensed service provider within a clear regulatory environment as a form of commercial bank money or private sector money. And the two things can coexist as they do today on centralized infrastructures. We have already today central bank money coexisting with commercial bank money. I don't see why this should not happen on another novel, probably better infrastructure like blockchain is.
Okay, questions. We have only 3 minutes, so please be very short on the questions and on the answers.
How do you put in relation the fact that when you talk about the blockchain, you say that it's an alternative financial tool related to traditional financing, so the currencies. So the currencies are inflated, okay, and so the stable coins should reflect the inflation as well.
What I was saying is that it's a different infrastructure, right? Instead of having a centralized infrastructure, because we didn't invent blockchain 40 years ago, in the last 40 years, we have created a centralized infrastructure for the representation and the exchange of value in the digital age. Who has to take care of the avoidance of the double spending, which is immanent to the digital world? You can always copy-paste strings of zeros and ones in the digital world. Well, it's the intermediary, right? So in terms of infrastructure, this is completely neutral to the fact of having or not having money, a type of definition of money. There is an institutional definition that can be inflationary or not, okay? We go into the theories of what money should be. Aristotle used to say that money should have 3 characteristics, be a mean of payment, be a measure of value, and be a reserve of value. But out of the 3, there was already a sort of trilemma at the time, whether it's a good reserve of value, say, non-inflationary. Well, sometimes it risks to be not a very good mean of payment, because people tend to hoard it, right? So we are talking about these things since 2,500 years. And I don't think that economists have a single view on the fact that money should be deflationary or inflationary or completely stable and so on and so forth. What I guess we are saying here is that this is infrastructure, being decentralized, avoiding the single point of failure problem, in any case lends itself better to the representation of money as society will decide it has to be. That's it. Okay. Yeah, monsieur, à la fin.
Yeah, good morning. My question is, what impact would you expect MiCA to have on stablecoin? That's question 1, and maybe question 2 related to that. Have you identified any flaws in MiCA that you think should be repaired to facilitate proper further development of stablecoin?
when you, first of all, MiCA is certainly the best way for all actors in blockchain to have a chance, especially in Europe, obviously, to be well regulated. Currently, it's a nightmare. We are a UK company. We have, against Brexit, we had to go to Ireland. We are fully regulated in Ireland, a bit in Germany for some things. But we can passport everything, such as EMI can be passported everywhere. MiFID II can be passported everywhere in Europe as well. When it comes to cryptocurrency licenses, it's not the case. You need, if you want to speak in French or in another language, you need to be regulated. So it's very difficult for companies to grow in this kind of market, not well regulated. And MiCA is bringing something very interesting for actors in blockchain, because we can, in a close future, passport these licenses everywhere. And about stablecoins, it's also a door to open for these companies, for these actors to grow and bring something for the retail market, for them to enter into it, very basically, as we discussed.
Okay, I just learned that we have more time for the questions, so let's enjoy.
Hi, last question. Thank you for your time, guys. My question is with regards to algorithmic stablecoins and instances, or how do you mitigate against the depegging and risks and failure of that algorithm? So, and to preface this, I work for a regulated US stablecoin issuer, USD, 100% fiat-backed, USD and JPY. So I'm coming from the other end of the spectrum, but I'm interested to understand what your risks are with regards to the algorithmic side of it.
From the algorithmic one, there's no, for example, there's Frax, which is the most common one or most popular one, but they still are too slow on really minting and burning. So the whole risk is that they are very slow in really pegging one-to-one. So it goes up, it goes down, and it really is too slow into going into the $1 peg, because it's really hard to make it on an amazing manner. We are even trying to do something similar, and we have many troubles. Probably from all the stablecoins, all the 4 ones that I mentioned before, is the most difficult one, although it's maybe the most decentralized one, but it's the most difficult one to really make, in my opinion.
I have a very basic question. How do these stable coins collateralize? Do they own dollars in a bank that's equal to the amount of the value of the stable coins? How do they do this?
Yeah.
And where does the money come from?
Answer. Simple answer. Yes, they can be, for instance, 100% collateralized, as the sir was saying, in bank accounts that are actually made transparent to the regulator, so that it can be audited.
Where does the money come from?
Well,
they raise it
from users that go to Circle, for instance, and it can be. I think that Circles tend to onboard wholesale clients, right? So they do their KYC logic on the corporate client that goes to them, and then they bring fiat money to Circle. That in exchange of this fiat money gives them the token that represents the stable coin. And the token is issued as long as there is $1 in the bank account that is coming from the client and is in the bank account of Circle.
And they all do this? Same?
No, not necessarily. This is the case of the perfect collateralization. Okay, some of them tend to take that money and, as you said, invest it in short-dated bonds, so quasi-money type of investments. Some others are more obscure in how they collateralize. That's why I was mentioning which is the risk. Well, that the collateralization doesn't hold, that is not perfect, right?
Okay.
The most
so it's kind
case,
of sounds safe.
Thank you very much. Unfortunately, we are running out of time, so we have to stop here. Thank you very much for the excellent panelists, and thank you, everyone. Bye-bye.
Thank you, guys.
Thank you. Thank you very much. Thank you for a very interesting discussion.